I'm Peter Gaylord, CEO of Gaylord and Belinsky Wealth Management. The topic of today's video is going to be diversification, strategic asset allocation, and rebalancing. And these are several approaches that are all tied closely together and a strategy that we use on a normal basis at Gaylord and Belinsky Wealth Management. So first I'd like to talk a bit about diversification. Most people, of course, are familiar with the concept where they don't put all their eggs in one basket. You know, they typically think of this in terms of owning several stocks, and diversification in that sense lowers risk because your portfolio return is not driven strictly by the increase or decrease of the value of a single security. Now, we take that a step further at Gaylord and Belinsky Wealth Management by using an approach called strategic asset allocation. And in strategic asset allocation, rather than necessarily purchasing individual securities, we're more interested in investing in particular asset classes, devoting a portion of a portfolio to one asset class, another allocation to a second asset class, and so on, until we construct and build up an entire investment portfolio. And the reason we do that is that when you have several asset classes, you're trying to achieve a particular target return in your portfolio. And by investing in several asset classes that may help you get to the desired return for your portfolio, you'll have asset classes that tend to move in different directions, or they may move in a similar direction but not exactly in lockstep. And what that permits you to do is to lower the risk in your portfolio, the deviation from your expected return in a particular year. Now, some examples of asset classes may be U.S. equities, fixed income, emerging markets, commodities, real estate, gold, or any number of other asset classes that may be appropriate for the amount of risk you want to take on and the target return you're trying to achieve. Now, you may ask, why would you use strategic asset allocation? Why can't we just go out and focus on buying a lot of good stocks or finding several good stocks and putting together a portfolio that way? Well, the key reason is that a number of studies have shown that 90% of the performance of an investment portfolio comes from being in the best or appropriate or a mix of different asset classes. It doesn't come through the selection of individual securities. Generally, your ability to pick, a quote-unquote good stock only accounts for about 10% of your overall portfolio performance. So rather than spend a lot of effort on analyzing individual securities, we prefer to determine what the appropriate allocation is for a particular asset class at a particular point in time. And generally those numbers, those allocations are driven by the amount of risk that an individual investor is willing to take and what kind of target return they're trying to achieve over time. And that guides what the allocations are. So now that brings us on to our next topic, which is rebalancing. Well, what is rebalancing? Well, rebalancing is simply a process whereby a portfolio is adjusted periodically, selling assets that have increased beyond their original target allocation and purchasing securities that have fallen below their original allocation. And what that does is it forces you to sell when your securities have gotten high and to buy when it's gotten low. So it enforces that basic investing discipline that we all want to achieve. So for example, if we had 20% of a portfolio in U.S. large cap equities and the market had run up in the U.S., the Dow Jones Industrial or the S&P 500, and let's say because of the increase in the value of that asset class, we'd gone up to 25% of the overall portfolio, we would want to bring that back to 20% by selling that incremental gain that we had achieved, and then spreading that money around to all of the other asset classes in our portfolio bring the portfolio back in line with the original target allocations. So that's an example of how you use strategic asset allocation. One remaining topic that's related to this is the idea of a tactical overlay. At certain times, when particular situations exist, or we think that the market's really run up way beyond where it should be, and we've seen examples of that, for instance, in the year 2000 with the NASDAQ, or more recently in 2008 with the financial crisis, we would apply a tactical overlay and perhaps sell off more of those securities than we might otherwise would. And on the flip side, if you look at a situation like 2009, where the markets had been really beaten down, that might be a situation where we might increase allocations from what they normally would be, putting more idle cash at work, and on the flip side, selling when the market's high to take more cash. But in general, the two elements are strategic asset allocation and periodic rebalancing, and that allows you to utilize diversification, achieve your target portfolio return over time, and to mitigate risk, and finally to buy low and sell high. So if you could use any assistance in your investing, or would like to talk to us some more about investing, or simply learn some more, we've got videos here on our YouTube channel. You can visit our website, GaylordBolinsky.com, or look for us on Twitter at GaylordBolinsky. We put out tweets with investing, tax, and financial planning tweets on a regular basis, and we hope you'll find those to be of interest. So we look forward to speaking with you. We've got more information in the comments section for this video, and thanks very much. Have a good day.